Adobe, famed for its software that helps people publish documents, create graphics and videos, just reported its latest results, gave a sales outlook that failed to calm investors who have been worried that the company won't hold its own against AI-focused upstarts. Let's get more on these results from Angelo Zino, Senior Equity Analyst at CFRA Research. Angelo, thank you very much indeed for joining us. What was number one for you with these Adobe results? What jumped out for you, please?
Yeah, so thanks for having me, Andrew. I'd say when we look at the results here, they were actually better than expected. So, you look at the numbers, I think it was about 11% top line growth. We were looking at something along the lines of closer to 9%. They actually provided guidance for the full year outlook, which is actually slightly above the street. However, when you start actually dissecting the numbers, it actually does point to decelerating growth here over the next couple of quarters. It essentially implies a growth rate closer to 9% or so in the August quarter, and then even decelerating further to about 8% in the quarter thereafter. So, when you kind of start thinking about all of this, overall, the numbers looked good, but there are still concerns out there, I think, about the long-term growth trajectory of this company. And it's hard, when you look at a given quarter here, it's impossible to really alleviate any of the fears out there that the bears have about some of the competitive pressures, as well as potential implications that AI could have on its business. But that said, execution was really good this quarter. They're still buying up a ton of shares. And, I think from a valuation perspective, this thing looks really enticing at these levels.
Although you may have mentioned this, you've got to buy, but you're cutting your 12-month target all the way down to $500 from 575.
So we cut our 12-month target price to $500 from $575. A big reason for that is we did lower the multiple that we are applying on forward estimates. A big reason for that is we're now being just a little bit more conservative in terms of the long-term growth outlook. We're essentially saying, hey, listen, maybe the long-term growth outlook is closer to about a 7 to 9% growth pace. And when you start thinking about and comparing a company like this to other software vendors out there, companies that maybe have a lower, let's call it a high single-digit growth rate, is going to have closer to maybe a low 20s type multiple. So we are basing it on a 22 times multiple on next year's earnings. But that said, I mean, again, the risk reward looks fairly attractive at these levels in our view. And in our view, we're actually being ultra conservative as well. And the company historically also is very conservative when providing guidance. I think that's another important point. So when you look at the guidance that they provided here for the rest of the fiscal year and the next quarter, we think it is overly conservative in nature.
And AI is still a pretty small part of their business?
It's a very small part of their business. And I think this is the other issue out there when you look at the disappointment in the reaction of the share price. I think, especially on the heels of Oracle, which just announced the prior day and essentially pointing towards a doubling of their bookings here over the next year and accelerating growth across not only the infrastructure business, but also in their SaaS side of things, their ERP management systems. When you look at Adobe, low single-digit growth, I mean, they're only looking for about a $250 million run rate exiting this fiscal year that ends in November. When you look at the year ahead, again, it's not going to be a big contributor in terms of the momentum for their top line. I think this is one thing that is important is it is adding stickiness to their ecosystem. You're actually seeing greater usage across their platform because of AI. AI is being integrated across all their different product offerings. So what we do think is happening is it is adding that stickiness to the installed base. So in a highly recurring business. So we expect the revenue to be sustained. The problem is it is slowing and they haven't necessarily figured out how to monetize it to the way that maybe some other vendors are successfully monetizing AI at this point. But it is still early days.